Currently, there's a surplus of private equity money chasing too few genuinely good investment prospects. If you've previously considered seeking investment from a private equity investor, there are a number of things you can do in order to optimally position your offering. Hi, my name is Ragavan Arunachalam. I'm a partner in the corporate and commercial team of Collier Bristow, and I also chair the firm's private equity audience group. These are my top 5 tips for successfully seeking private equity investment. Tip 1, know your target market. This talk is aimed at companies seeking investment, and in particular, founder management teams who are prepared to give up equity in the company they own in order to get access to the capital and potentially expertise they need to take their company to the next level. The most successful outcomes start with rigorous planning. The first step in planning is understanding where you want to end up. When seeking investment into your company, it is therefore critical that one understands the different funding options out there, and in particular, the difference between private equity and venture capital. In this instance, the key difference boils down to when the investment is being sought. Companies have life cycles, and depending on whether your business is a startup trying to establish proof of concept or a mature entity with proven consistent revenue streams, the type of investor you're going to attract and should be targeting, therefore, will be different. If you're a mature business with steady but unspectacular growth, you're unlikely to attract the interest of a venture capital or VC fund. The investment model of a VC fund relies on hypergrowth, with the creation of unicorns, privately owned companies which are valued over 1 billion, balancing out the many investments they make which fail to achieve such stunning success. Conversely, if you're a startup which cannot evidence steady growth, but only the potential for hypergrowth, then you're unlikely to be of interest to traditional private equity. I say traditional private equity as there are always more niche investors who will not fall into the broad categories just discussed. Traditional private equity tends to focus on what I call a value proposition. They seek to invest into a company which has demonstrated consistent historical success and where there's a clear pathway to achieve much more success in a relatively short time period if the company is resourced properly, both in terms of capital requirements and expertise. In essence, if you're on the hypergrowth pathway, you will likely be looking to target VCs. And if you have a value proposition, you should be looking to more traditional private equity. For the rest of this talk, I'm going to focus on more traditional private equity, as I have a number of clients in this space and hopefully, therefore, an insight into their thought processes. Having made the decision to seek investment from a private equity investor, the next step is understanding what your prospective investor wants to achieve, so that you can build your business case accordingly. Not all investors are the same, and whilst all investors will want to achieve a successful exit, the pathway to such an exit will potentially be different. All investors will be assessing the opportunity to invest into your company against their own internal investment criteria. It is therefore key that you understand the benchmarks that are likely to be of importance to them and position your case accordingly. The investor will need to see clear and solid financial data which support your business case. Critically, the business case will need to align with the stated exit strategy of your investment partner. Providing the investor with the right information and demonstrating your alignment with the exit process will put your nascent partnership on the road to success by ensuring all parties are on the same page. Tip 2, make sure your house is in order. When seeking to attract investment, it is of vital importance that your business case and the underlying assets of the business which will deliver the business case are copper-bottomed. Invariably, as part of the investment process, both you and your company will be subject to rigorous due diligence. This due diligence will cover various areas of the business: financial, legal, and perhaps even commercial or technical, depending on the area within which you operate. It is far better to ensure that prior to this process, your house is in order than try to deal with skeletons as and when they fall out of the closet. In order to negotiate the best terms, it is paramount that you're controlling the narrative of the discussions, and it's not going to help your prospects if you're firefighting from day one. Getting ahead of issues prior to an investment process starting will help you manage discussions regarding price and, in addition, risk apportionment. The relationship between a company seeking investment and an investor is a delicate one. It is key that the investor trusts the recipient of its capital. Key to building that trust will be convincing the investor that your company is built on solid foundations. As part of the investment process, it might be worthwhile getting in external advisors to kick the tires of your business. Good advisors will not only be able to identify weaknesses in the business case you're putting together, but also advise you on the best way to remedy or mitigate any issues which have been identified. It is often the case that when setting up a business, resources are stretched. This means that capital is much more likely to be deployed supporting business critical needs, rather than necessarily ensuring all the I's are dotted and T's are crossed. It is a rare company indeed, which from day one has appropriate documentation covering all legal issues, such as the relationship between existing shareholders, with its employees, regarding its intellectual property, or with its suppliers and customers. Of the various issues a company may have, one of the most common is working out how to deal with a disparate shareholder base. Often smaller companies need to be bootstrapped with the help of friends and family, or with individuals being prepared to work for the business in exchange for shares rather than a salary. Whilst incentivizing individuals with shares or raising capital by more modest equity issues, particularly when cash is at a premium, might sound like a good idea, sometimes it can cause problems in the future. Private equity investments generally work best when the number of shareholders is limited to key stakeholders. If the shareholder base of a company is too numerous, it can make it potentially more difficult to align the different interests of each shareholder. This is particularly true if the constitution of the company, whether that be the Articles of Association or the Articles combined with the shareholders agreement, has not been well thought out. It's going to be difficult to close an investment round if the company does not have levers it can pull to bring shareholders into line. A well-drafted shareholders agreement in combination with appropriate Articles of Association is the best way to ensure future investment rounds proceed smoothly. These documents set the expectations of all parties involved and mitigate the chance of individual shareholders skewing or holding up future investment. Getting your house in order is key to a good investment outcome, and therefore, as we have not covered all the key issues, if you do need further guidance on this topic, please do get in touch. Tip 3, make sure the relationship with your investor is appropriately documented. The advice here really depends on the structure of the investment. The recommendations for a company issuing a majority stake to an investor or a minority stake will differ. For example, an investor facilitating a management buyout will be keen to ensure the management team are appropriately incentivized by well-drafted good and bad leaving provisions. If part of the business plan is to align the interests of management with continued growth, the investor, when negotiating the key investment documents, will seek to reward behaviors that contribute to that growth and disincentivize those behaviors that do not. The main way to do this is to allot and issue shares to management, such that as the target grows in value, so do their shares. To motivate management to stay with the target and on track with the business plan, an investor will insert good and bad leaving provisions. These provisions essentially penalize management who leave or otherwise underperform by, for example, reducing the economic value of their shares to nil, and reward those who stay and help grow the target by protecting the value of the shares they have. This is a simplification about how good and bad leaver can work, but the key takeaway should be that if a company is seeking investment from private equity, then management, the minority shareholders in general, need to be careful that their incentivization is properly structured and cannot be artificially manipulated. Equally important, especially if the management team is going to be left with a minority position, will be ensuring that the value of their shareholding cannot be manipulated by the issue of new shares or similar. This can be protected in several ways. There could be preemption rights on the issue of new shares, which would give all shareholders the ability to participate pro rata in future fundraisers. There can be anti-dilution protection, which would increase management shareholdings at little or no cost to them to prevent any dilution. Or simply, there could be a right of veto on the issue of new share capital without management's consent. If there's a majority and minority shareholder, the majority shareholder might wish to insert drag-along provisions into the company's Articles of Association to ensure that, should they wish to sell the company in the future, the process cannot be stymied by a reluctant minority. Often a third-party buyer will want to ensure that they can purchase 100% of the issued share capital. A drag-along provision ensures that if the majority shareholder finds a buyer for their shares, then they can drag along the minority shareholder with the proposed sale, usually on the same terms and for the same price per share. This would potentially make it much more likely that the majority shareholder will be able to realise the value in its shares. The corollary of this provision is tag-along. This applies where a minority shareholder is anxious that the majority shareholder might sell their stake to a third party without ensuring that the minority can exit at the same time too. To avoid being left with a new majority shareholder with whom they don't have a good working relationship, tag-along rights would step in, ensuring that the majority shareholder cannot sell without the minority shareholder being able to sell their shares on the same terms. In addition to what we've already discussed, topics such as management consent rights, i.e. the ability for management to veto material commercial decisions, information rights, to allow minority shareholders to monitor the financial performance of the target, and negotiating board control are key to ensuring that management do not lose all control to the incoming investor. Tip 4, stay on track and manage expectations. Hopefully you have identified the correct investor, got your house in order, and therefore obtained good terms for the investment. Once the investment terms have been appropriately documented, the next step is delivering the business plan. During this process, it is critical that channels of communication with the investor are clear and you continue to evidence your alignment with the overall exit strategy. As well as keeping your investor appropriately informed about what is going well, it's equally important that you manage both the optics and promptly implement suitable solutions if there are any setbacks on the critical pathway to an exit. If there are hiccups in the business plan, in particular where the deployment of additional capital and expertise is not having the intended effect, be sure to consider whether the plan needs to change. If you're going to change the plan, then make sure you bring along your investor on the journey of why it needs a change. In addition, ensure you have an action plan for those areas of the business that were identified by any legal due diligence as being suboptimal. Now that the investment into your business is completed, the last thing you want is for your plan for growth to be derailed by, for example, easily avoided litigation. Finally, make sure you leverage not only the capital, but the know-how that your investors should be bringing to the business. Once an investor has deployed their capital, it'd be foolish not to avail yourself of their expertise, network of connections, and resources, with perhaps a deeper dive into areas of your business which can be optimized. Tip 5, ensure a smooth investment process by having stuck to tips 1 to 4. Make sure you pick the right investor. The right investor will be aligned with your vision of how to grow your business and also the shape and timing of the exit. Make sure the financial, legal, and commercial affairs of your business are in order before seeking investment. If you cannot provide the perfect picture, at least try to evidence that you have control over key stakeholders who might impact the success of an investment. Make sure you robustly negotiate the key documents governing the terms of the investment and control your business going forward. In particular, make sure you can't be forced out or sidestepped if you have driven an increase in value. Make sure you maintain clear channels of communication with the important stakeholders involved in the investment. Get ahead of any issues with the business plan and be prepared to be agile in your delivery of an exit. Follow these key points and your path to growth should be made slightly easier. My name is Ragavan Arunachalam, and these have been my top 5 tips for successful private equity investment. Thanks for listening, and please do not hesitate to get in touch with Colin Bristow if you have any questions or require assistance in this area.